ahead and get started. Thanks for joining us today. This is the podcast where we talk about estate planning, legacy planning, and the things that are important to you to make sure that your family and your assets are protected and taken care of in the case of emergencies. What we're going to talk about today is an aspect of special needs planning, and it's extremely important because what happens is when you have a special needs child, whether they're a minor or whether they're an adult, many times they can qualify for public benefits. Those benefits can be in the form of, Medicaid or, Medicare coverage, depending on how old they are. It can also be in the form of Social Security or SSDI support. And those benefits are basically contingent on being able to qualify under certain economic guidelines and under certain qualification guidelines. So a lot of times when you have a child that has special needs, they may qualify for those benefits on their own, but because you're their parent and they're a minor still, your assets and your income are counted in the application to see whether they can qualify for benefits. So a lot of children that are minors, go without those benefits because the parents' income and assets don't qualify them. But that's not the case when the parents pass away. Now the child doesn't have, those assets or income to count because the parents are no longer there. So they can qualify on their own. But if they receive an inheritance, they could be disqualified, right? And it's the same thing when the child turns 18. So if you have an 18-year-old or older and they have qualifying disability, they would normally qualify for a variety of benefits depending on what state you're in, but they could lose those benefits if they come across significant assets or if they have too much in income. And so it's important to make sure that we preserve those. So what we're going to talk about today is a strategy called an ABLE account. And this was approved by Congress, I think it was about 4 years ago. But basically, it's Achieving a Better Life Experience account, and shortened to ABLE. The purpose for the ABLE account is to allow individuals that have a qualifying disability to save up money and to be able to use that money for their needs in the future without affecting their eligibility for benefits. So that's a good thing because a lot of times families, parents, even the individuals themselves, they live in fear of saving up too much money. If you're over $2,000, then that's generally the guideline that can disqualify you from benefits. But in the case of an ABLE account, if you can qualify for it, and in order to qualify, your qualifying disability diagnosis basically had to have been given before you turned 26. If you can qualify for an ABLE account, then you can save up to $100,000 in this account, and it doesn't disqualify you from benefits. So you're not affected by having to count what's in the ABLE account against your asset limits for purposes of keeping your benefits. And in an ABLE account, the assets inside can be invested, they can grow. Every state has a different ABLE account program, and that program works on the same principles, the same program as the state 529 plan program. So for those of you who are familiar with 529s, 529s are the accounts that individuals set up for purposes of paying for college for children. The 529 plan has a variety of investment options that are managed at the state level and that you can choose on an individual level for your investment. And when you put the investment in, a lot of states will give you a credit for what you put into your 529 plan for the children for purposes of state income taxes. Some of those 529 programs have specific, benefits in terms of very, very small management fees and sometimes other advantages. So the ABLE program works on the same program as the 529 program. And some states have, really chosen to beef up their ABLE accounts. to make it more competitive. That's one of the reasons why it's administered on a state level, is that states can be in charge of, you know, differentiating their accounts, differentiating their offering from other states, and gives some incentive to forum shop. So some of the best ABLE account programs, the way they're administered, the ease of access, and so on and so forth, are the state of Minnesota, the state of Florida has a good one, and then the state of California has done something very interesting with their ABLE accounts, because normally at the federal level you can only save up to $100,000, and then that $100,000 doesn't get counted against your benefits for purposes of qualification. However, in the state of California, because they have their programs administered on a state level, you can save up to $300,000 in your ABLE account, and it won't affect your state benefit eligibility. It will still affect your federal benefits, but it will not affect your state benefits, which is kind of cool. So $100,000, it seems like a very large amount. The only catch is that any individual putting assets into the ABLE account can only put $15,000 per year. So cumulative, you can put $100,000, but if you had, for example, a settlement from a lawsuit, maybe you have a child with a disability, or maybe you have a child that, because of an accident, uncovered a disability, and they receive a settlement in a lawsuit. It might not be a good fit to be able to put it directly into an ABLE account, because you can only put in $15,000 per year. But cumulatively, you can put in $100,000 into the account. The other thing about the ABLE account is, when the money goes in, it doesn't generally. There may be some states that give a credit or something like that for income tax purposes, but generally it doesn't affect your income taxes. It's not a deduction. However, when the money grows, it can grow tax-free. When it comes out, if it's used for qualifying expenses for the benefit of the individual that has, the special need or the qualifying disability, then it comes out tax-free, just like a 529 plan would, which is a huge advantage for purposes of growing your income, growing your savings inside of the account. So where do we use these ABLE accounts most often? There's two situations where we most commonly recommend using an ABLE account. And the first one is, if you have a child that's under age 18, and because of your income and your assets, they are able to qualify for benefits, and you want to save up some money for the purpose of taking care of that individual, that child, in the future, but you don't want to affect your eligibility for benefits right now, that's a perfect situation for using an ABLE account. That money has to be earmarked for your child with the qualifying disability. However, that might free up money for other things that you can use, what you would normally be spending or saving on other things. So that's one of the advantages. The other situation that's very common is, if your child turns 18, now they're an adult. Now their income and their assets are what get counted and what is going to qualify them for purposes of benefits. So if you have an adult child with a qualifying disability and they're earning income, sometimes they have a part-time job, maybe a full-time job, and they're earning more than what they need on a monthly basis. Maybe it's a couple $100 a month. Maybe it's a couple $1,000 a month. Who knows? And that money in excess would potentially disqualify them if they start saving it up, disqualify them from benefits. Well, the ABLE account is the perfect place to be able to put that money and allow it to accumulate, and to be able to get interest and to be able to accumulate and use it for some purpose in the future. And that may be, paying for care. It may be for, educational opportunities. It may be for, rainy day fund for emergencies. It may be for healthcare costs. Whatever the purpose is. So those two situations are ideal for using the ABLE account. Now, a lot of times we do planning with families, and they ask us, should I have a standalone special needs trust? Because, we want to accumulate some savings, we want to accumulate some money, and we don't want to affect our benefits. Depending on how much you want to accumulate, the ABLE account may be a better option. A standalone special needs trust is generally not needed unless you're saving large quantities or unless the money's coming from a third party, not from the individual with the disability or with the qualifying situation. So a lot of times, instead of recommending a standalone special needs trust, we'll do a standard special needs trust, testamentary special needs trust structure together with an ABLE account, because the ABLE account gives you this slush fund to be able to use without affecting benefits up to a limit. And then you have your special needs trust to protect against the possibility that the parents pass away and that there's an inheritance received. So the ABLE account is a very useful tool. It's a very powerful tool. But the last thing I want to share with you, which is very important to remember, is that it does have a recollection provision that you have to be aware of. What does that mean? Well, it means that if you have money in your ABLE account and you don't spend all that money before passing away. So, for example, if you have a child with a qualifying disability or special need, and they qualify for an ABLE account and they save up some money in there, but then they pass away before all that money is spent, then the state Medicaid department will be able to collect against that account first before it transfers to anybody else. So that recollection provision, it's common. Even when we do like self-settled supplemental needs trust, special needs trust, that recollection provision can be common. But specifically for an ABLE account, it's an automatic thing that's included. The state will be able to collect against that account if there's anything left at the time of death. And so that's one thing to be aware of. And that being said, it's a very powerful tool and a very cost-effective tool to be able to address specific scenarios and specific needs that your child or that your family with qualifying disabilities may have. So we're going to open it up for questions. I believe we have at least one question. And we'll see if we can get this to work to unmute you so that you can ask your question. My staff is able to do it for me, that would be helpful. I'm not familiar with how to unmute people.
She should be able to unmute now. She's been invited to speak. Okay. I have a question. I'm doing so my client is a beneficiary, but is receiving government benefits. So should I do a standalone for her?
So when somebody receives an inheritance from an existing plan from a third party, or when somebody receives a settlement from like a lawsuit or something like that, and it comes in a lump sum, then a standalone trust is a great option because an ABLE account may or may not actually be able to receive that money.
Okay. So standalone special needs. Okay.
And remember that in order to qualify for an ABLE account, their diagnosis has to have been received before they turn 26. Taxpayer.
Okay.
If it's a revocable trust, a lot of times it's treated as a trust. It flows through to the grant or tax return.
Okay.
And so it just depends on how it's structured, but most likely it will flow through, pass through to the individual tax return during their lifetime, and then it'll turn into an irrevocable trust with its own tax return after they pass.
Okay. So, but let's say that let's say money is transferred to an special needs trust, irrevocable special needs trust, then is that taxed as for the beneficiary or the let's see.
So if it's taxed at the trust tax level, then
okay.
the trust will have to pay the taxes at trust tax rates.
Okay.
If it's a pass-through to the individual, then the trust can provide the money to pay for the taxes, but it'll pay it at the individual tax rates.
Okay, I understand. Okay, thank you very much for clarifying that. I appreciate that.
All right, thanks for being on.
Thank you.
All right, well, we're going to wrap this one up. We appreciate you joining in today. We are going to continue this conversation about special needs planning in future podcasts. We have past podcasts that you may or may not have listened to yet that also touch on special needs planning. That can be a valuable resource for you. So we invite you to like, subscribe, wherever you get your podcasts, follow us so that you can continue learning more about legacy planning, estate planning, how to protect your assets, and how to protect your loved ones.